Welcome back to Iron Financial. This is the only place where we forge stronger portfolios by taking the market's biggest headlines and putting them under extreme pressure. And today, we are putting Bumble squarely on the anvil. The company just released its Q4 and full year 2025 earnings. And folks, the numbers are a paradox wrapped inside a riddle. I want you to think about this. How, in any logical universe, does a company report a net loss that is staring down the barrel of $1 billion, and then its stock just rockets up over 21%? No, that is not a mistake. A jaw-dropping loss followed by a massive face-ripping rally. So our job today is to hammer this thing out piece by piece. We're going to find out if Bumble's foundation is really being rebuilt with steel, or if this is all just cosmetic work papering over some deep structural cracks. All right, let's get into it.
Okay, hold on. Let's just park it right here for a second, because these two numbers on the screen are at war with each other. In one corner, you have a loss of almost $1 billion, $906 million. In any normal business, that is a full-blown five-alarm fire. That's a get everyone out of the building moment. But in the other corner, you have the stock market, the supposed collective wisdom of every investor, throwing a party and sending the stock up nearly 22%. So what is going on here? Is the market just completely unhinged? Are traders just blindly buying hype? Or is there something buried so deep within these financial statements that the headline loss is a complete and total smokescreen? Because I gotta tell you, from a surface-level view, this makes absolutely zero sense. You don't fail a test this badly and get rewarded with a promotion. It just doesn't happen.
You've hit the nail on the head, and finding the answer is exactly what we're going to do today. This is our blueprint. This is how we're going to attack this. First, we'll set the stage and look at this very confusing quarter. Then, and this is important, we're going to deconstruct the damage. We'll start with the bear case and find every single weak point. After that, we're going to examine the story that management is telling investors, what they're calling the quality reset. And then, this is the most critical part, we're going to forge into the real numbers to see if a stronger core is actually being built underneath all this noise. Finally, we'll bring it all together and deliver our verdict. Is this a rock-solid opportunity or a carefully laid trap?
All right, Section 1, the confusing quarter. Before we go any further, you have to understand something about earnings reports like this one. The big, scary headline numbers, like that massive loss, can be incredibly misleading if you don't have the full context. They're designed to grab your attention, for sure. They tell a story, but it is never the whole story. To really assess a company's structural integrity, to see if the bones are good, we have to look right past that initial shock and start analyzing the metrics that actually carry the weight of the business.
See, I'm still not convinced. You're saying the market is smart, but the market gets swept up in hype all the time. A near billion-dollar loss isn't just a headline, it's a crater on the balance sheet. In my book, that's a bright red flag for profound systemic problems. It could be the business model, it could be the product, it could be both. A number like that just screams that the company is burning through cash and is in a race against the clock. So before we even give an ounce of credit to the bull story, we need to really understand the damage. Just how bad is the bad news when you get right down to it?
And you are absolutely right. You always start with the bear case. It's the only way. You have to take your biggest hammer and swing it at all the weak points to see if the structure can actually take the pressure. So let's start right there. Let's examine the stress fractures that are plain to see in this report. We're going to zero in on two things: top-line revenue and the paying user base. These are supposed to be the two main pillars holding this entire company up. Let's see how they're holding up.
First things first, let's look at revenue for the full year 2025. The company brought in $965.7 million. Now that's a big number, but it's where it came from that matters. And it's down 9.9% from the $1.07 billion they did in 2024. A nearly 10% drop in your yearly sales is not a small problem. That is a significant crack in the foundation. It tells you clear as day that demand is shrinking. The company's getting smaller, not bigger. This is the first major red flag waving right in our faces.
And the really worrying part? This trend is not getting better, it's actually getting worse. If you zoom in and just isolate the fourth quarter of 2025, that revenue was down a whopping 14.3% compared to the same period the year before. So what does that tell us? It tells us that the negative momentum was accelerating as the year went on. Whatever problem they had at the start of the year was intensifying by the end. For a tech company that's supposed to be all about growth, that's a very serious concern.
And this chart just paints the picture perfectly. You don't even need the percentages, just look at the bars. A shrinking top line is a fundamental, undeniable weakness. You can try to talk about profits, you can try to talk about margins, you can talk about a grand strategy all you want. But if your total sales are heading south, you are fighting a losing battle. The entire pie is getting smaller. The very foundation of the business, the money it brings in the door, is eroding right before our eyes. That's not a hairline crack, my friend. That is a significant fracture in the base.
Exactly right. And it gets worse when we look at the engine of the business, the actual people paying for the service. For the full year, the total number of paying users, people willing to pull out their credit cards, dropped by 11.5%. Now think about that. That decline is even steeper than the revenue decline. This is a huge clue. It suggests the core problem isn't just about what they're charging, it's about the appeal of the product itself. Fewer and fewer people are looking at Bumble and thinking, yeah, this is worth paying for.
And there it is in black and white. You don't need to be a Wall Street analyst to understand this. They went from 4.1 million paying customers down to 3.7 million. That's 400,000 people. 400,000 customers who were paying them last year looked at the app this year and said, nope, not anymore. This is a massive vote of no confidence from the user base. It directly attacks the product's value proposition. Are people just getting tired of it? Is another app eating their lunch? Whatever the reason, losing paying customers is the loudest, clearest signal you can get that a business is under serious duress. The customer base, the very people who built this company, is literally crumbling.
Okay, so we have absolutely established the bear case, and it's a strong one. You've got shrinking revenue, an accelerating decline, and a user base that is bleeding customers. And honestly, this is where most analysts would stop. They'd see this, call it a day, and slap a sell rating on the stock. But these numbers, as frankly terrible as they look in a vacuum, don't tell the whole story. Management is making a bold argument here. They're saying this wasn't an accident. They're saying it was a demolition, a deliberate, painful, and strategic teardown, all so they can build something much, much stronger. This is what they're calling the quality reset story.
So this quote from the CEO, Whitney Wolfe Herd, is absolutely crucial to understanding the bull case. The key phrase here is deliberate choice. She's framing this whole mess not as a failure, but as an intentional strategy. What do? They took their performance marketing spend, that's the ads you see everywhere, and they slashed it by over 80%. When you turn off a fire hose of advertising money like that, what do you think is going to happen? Of course, your user numbers and your revenue are going to fall off a cliff. The story they are selling to Wall Street is that they knowingly accepted all of this short-term pain in order to purge low-quality users and refocus on trust and authenticity. The idea is to forge a more durable, long-term foundation.
Okay, I can follow the logic of a quality over quantity argument. It makes some sense. They trim the fat to get a leaner, better user base. Fine. But let's get back to the 900-pound gorilla in the room. A strategic reset that involves cutting your ad budget doesn't magically create a $900 million loss. That isn't just lost sales. That is a catastrophic number that has to come from somewhere very specific on the accounting statements. So how do you get from a quality reset to a hole that deep on your income statement? The math isn't adding up for me. And that question right there is the key that unlocks this entire paradox. The massive loss didn't come from running the business day to day. It came from a special accounting charge called an impairment. Now, the most important thing to know about this is that it's a non-cash charge. It's not real money walking out the door. It's an accounting fiction. It happens when a company looks at its books and admits that an asset they own, usually something called goodwill from an acquisition they made years ago, isn't worth what they thought it was. They're essentially just admitting on paper, hey, we overpaid for something in the past, and now we're correcting the value on our balance sheet.
And the size of this particular correction is absolutely staggering. For the full year of 2025, Bumble took a single non-cash impairment charge of over $1 billion. To be precise, $1.039 billion. Now, look at that number. And remember, the total net loss was $906 million. The non-cash on-paper accounting charge was larger than the entire reported loss. This one line item, this one accounting entry, single-handedly explains the entire scary headline number. The market, the smart money, they saw this. They knew how to read the fine print, and they understood that the actual operational business didn't really lose this money.
So now that we've cleared away that billion-dollar cloud of accounting noise, we can finally get to work. We can actually test the true operational strength of the business. We can finally ask the real question, is management's story about building a stronger base just a story, or is it actually backed up by the hard data? Let's dig into the load-bearing metrics that the market was really looking at when they sent that stock flying.
This table right here, this is the bridge. It's the bridge from the confusing world of GAAP accounting to the simple reality of the business operation. It's simple math. You start with that big, ugly net loss of negative $906 million.
Then you add back that non-cash impairment charge of over $1 billion. You add back a few other non-cash or one-time items like stock-based compensation, and just like that, you emerge on the other side with a positive adjusted EBITDA of $313.6 million. This is what Wall Street means when they say they're looking through the headline number to find the underlying profitability.
Now this is where my ears perk up. This is where it gets really interesting. We just established that the revenue fell by almost 10%. But look at this. Their core profitability, what they call adjusted EBITDA, it actually went up. It grew from $304 million in 2024 to over $313 million in 2025. This is the first piece of hard evidence that this quality reset wasn't just talk. It seems they successfully cut the less profitable users and inefficient marketing, and the business that was left behind became more operationally efficient. The structure is actually carrying the load more effectively.
And the margin expansion proves that point beyond a shadow of a doubt. Their adjusted EBITDA margin expanded from a solid 28.4% to a very, very healthy 32.5%. Let me be clear, this is a huge deal. This shows that for every single dollar of revenue they brought in, they kept more of it as profit. They are becoming a leaner, meaner, more powerful, and more robust operation. This is tangible, undeniable proof that the strategic demolition is actually leading to a stronger final build. But this chart, for me, this is the single most compelling piece of evidence on the entire deck. Forget adjusted EBITDA. Let's talk about real cash, net cash from operating activities. This is the lifeblood of any business. It's the actual physical cash that the company's core operations are generating. And look at it, it more than doubled. It went from $123 million in 2024 to $250 million in 2025. So while all the newspaper headlines were screaming about $1 billion paper loss, the company's actual cash-generating engine was firing on all cylinders, and in fact, became twice as strong. This is what gives a company true durability.
And this piece of data really ties a bow on their whole quality over quantity story. Yes, we know they have fewer paying users. We hammered on that point earlier. But the users who decided to stick around are proving to be more valuable. The average revenue per paying user, or ARPU, it ticked up from $21.23 to $21.64. It's not a giant leap, but it's an important signal. It shows that they are successfully monetizing that higher quality user base they claim to be building. They're getting more out of a smaller, more committed core of customers.
So you've got a business with improving margins, soaring cash flow, and better monetization. The final piece of this puzzle, and the real catalyst that probably lit the fuse on that stock rally, was the strong forward guidance. Management stepped up and told the world what to expect next. For the first quarter of 2026, they guided for revenue that was right in line with what analysts expected. But, and this is the big one, their adjusted EBITDA guidance of $76 to $80 million absolutely blew past the Wall Street consensus estimate of around $57 million. This was a direct signal to the market. The management is extremely confident that the painful reset is over, and a new era of highly profitable growth is about to begin.
Okay, that brings us to Section 5, the final verdict. We've done the work. We've hammered on the bear case, we've stress-tested the bull case, we've seen the demolition, and we've examined the blueprint for the new foundation. Now it's time to put it all together and determine if Bumble's structural integrity is sound enough for investors. Is this a real opportunity to build on, or is it a value trap waiting to collapse?
So here it is, the final weigh-in. The structural strengths are now impossible to ignore. You've got growing profitability margins, you have incredible cash flow generation, you're getting higher monetization from your best users, and you have a very confident management team guiding for a strong future. The new foundation they've laid appears to be solid steel. But the risks haven't just vanished into thin air. That user base is still shrinking. That trend has to stop and it has to reverse, or none of these fantastic efficiency gains will matter in the long run. They're also betting the farm on a big Bumble 2.0 product relaunch, and execution on something like that is everything. A botched launch could undermine this entire turnaround story. And you can never, ever ignore the brutal competition in the dating app world or the risk that a weak economy could make people think twice about paying for any subscription. Those external pressures are very real.
And that right there is the billion-dollar question that the market is now betting on. The story is powerful, it's compelling. A painful but necessary reset has forged a stronger, leaner, more profitable core business. The key metrics we've stress-tested today, especially cash flow and margins, they strongly suggest that the foundation is indeed solid. But the structure isn't finished yet. The company now has to prove that it can build on top of that new foundation and actually start growing its user base again. So we'll leave you with this final thought. With the heavy lifting of the reset now behind them, is Bumble's foundation truly forged for a new chapter of growth, or will the persistent, nagging pressure of a declining user base ultimately cause the entire structure to buckle under its own weight? That's what we'll be watching. Thanks for joining us on Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.